Hey everyone, welcome back to Corporate Decoder, the place where we decode the money moves of the corporate world. And tonight we're diving into CubeSmart's latest filing, a report that's got some interesting financial maneuvers that could tell us a lot about where they're headed. CubeSmart LP has just released its current report for August 20th, 25, and it's mostly about big money deal they've made. They've basically borrowed a whole lot of money to keep things running smoothly. So let's break down what that means. So CubeSmart LP and its parent company CubeSmart have just sold a massive amount of debt. They've issued what they call senior notes, which is just a fancy way of saying they've borrowed money and they owe it back with interest. The total amount is a whopping $450 million, and these notes are due way out in 2035. That's like borrowing money for the next 10 years. This means CubeSmart, the overall company, is guaranteeing that debt. It's like a parent co-signing a loan for their kid. They're saying if CubeSmart LP can't pay it back, we will. Now, let's talk about the impact of this borrowing after all the fees and discounts from whoever is helping them sell these notes. CubeSmart is walking away with about $440.2 million. That's a lot of cash. So what are they doing with all this new money? Well, they plan to use it to pay back some existing loans they have on a credit line, and a portion will go towards general business stuff like everyday expenses and maybe even buying back some of their other existing debts. This is a pretty common strategy to refinance and consolidate debt to potentially get better interest rates or just to manage their borrowing more effectively. The official document laying out the terms for this borrowing is called an indenture. It's like the rule book for this debt, and they've actually updated it with something called the 11th supplemental indenture. The fact that they're making these notes a big deal by having a separate supplemental indenture shows how important this borrowing is. Let's dig into the interest rates. These notes will cost them 5.25% per year, which isn't too high in today's market, especially considering the long 2035 payoff date. Interest payments are due twice a year in May and November, starting in 2026, meaning they've got a little breathing room before the payments really kick in. Now, it's important to understand that these notes are senior unsecured debt. That means they're treated as a high priority to be paid back, but they aren't backed by any specific company assets like property or equipment. Think of it like this: if the company goes under, say if they have to sell off assets to pay debts, the people who bought these notes get paid before common stockholders, but after people who have secured loans, meaning loans backed by specific assets. CubeSmart also has the option to pay back these borrowings early before the 2035 deadline. But there's a catch. If they do this before August 1st, 2035, they have to pay back the original amount plus a bit extra. This bit extra is calculated based on what they would have paid in interest between the early repayment date and the original due date, plus a little bonus on top of that. It's basically a penalty for paying them back too soon so they don't miss out on all the interest payments. However, after that specific date, August 1st, 2035, they can pay back the notes at face value plus any interest that's already owed. This is often referred to as the par call date, and it means if interest rates fall significantly, they might be incentivized to refinance again at that point. The agreements for these notes do come with some strings attached. They include rules or covenants that limit what CubeSmart LP and its related companies can do. For instance, they can't just take on a lot more debt or borrow money secured by specific company assets without meeting certain conditions. It also says they need to maintain a certain level of unencumbered assets, meaning assets not already pledged as collateral to back up their unsecured debt. This is a pretty standard way for lenders to protect themselves, ensuring the borrower has enough assets to cover their obligations. The details of this entire deal were outlined in a prospectus supplement filed back in August. This document essentially fleshes out all the terms and conditions of the notes and the company's guarantee, making sure investors have all the information. But to top it all off, they've included a legal opinion from their lawyers, Troutman Pepper Locke LL. This confirms that the notes and the guarantee are legally sound and properly issued. So not only is the company making financial moves, but they're also making sure they're doing it by the book. The report is signed off by Jeffrey P. Foster, who holds a pretty important role as the Chief Legal Officer and Secretary for both CubeSmart and CubeSmart LP. This tells us that the legal aspects of this major financial decision have been thoroughly reviewed. So to wrap this up, CubeSmart has successfully raised a significant amount of capital through issuing debt. They are using this money strategically to manage their existing debt and fund their operations. This is a pretty standard corporate finance move to ensure liquidity and manage their financial structure long term. Now for my take, CubeSmart is in the business of self-storage, a sector that's generally seen as recession resistant. People still need to store their stuff, even when money is tight. Borrowing $450 million to manage and potentially improve their debt structure seems like a prudent step, especially when they have a clear plan for using the funds to pay down other debts and for general corporate purposes. The covenants are typical for this kind of debt, ensuring responsible financial management. The key risk here, as with any debt issuance, is the company's ability to generate enough cash flow to service this new debt, especially with the interest payments they'll be making. The long maturity date of 2035 gives them ample time, but economic downturns or increased competition in the self-storage market could put pressure on their earnings. Overall, CubeSmart appears to be making solid financial decisions to strengthen its balance sheet and ensure continued operational flexibility. This debt issuance shouldn't be seen as a sign of distress, but rather a strategic move to optimize their capital structure. It will be interesting to watch how they deploy this capital and how it impacts their future financial performance. What are your thoughts on CubeSmart's latest financial move? Do you think this debt issuance is a smart play or a worrisome sign? Let me know in the comments below. And if you found this breakdown helpful, give this video a thumbs up and subscribe for more deep dives into corporate finance. Don't forget to join our Discord community linked in the description to continue the conversation. Thanks for watching and we'll see you in the next one.